Chris Gannatti, the European economy was making a comeback through quantitative easing, but the Paris terror attacks really have changed the equation. How will they affect the European economy over the short, medium, and long term?
So the fact of the matter is, last Friday's events, truly a terrible thing to behold on the world stage. But the way we look at it is, if you think, and I love how you broke down short term, medium term, long term. In the short term, you have to expect the potential for increased volatility, risk off, sentiment. None of that would be surprising. However, medium to long term, what we've seen historically, because unfortunately it's not the first time there's been a terrible event, is markets and economies have displayed a certain resilience. They've always come back, they've always ultimately recovered, and we think the Europeans are going to be resilient and ultimately recover from this issue.
Well, you have the Europe Local Recovery ETF. This is the ticker EZR. It's a relatively new exchange-traded fund. So tell me why now is a good time to be in this particular ETF. What's in it?
So when we looked at the amazing success we'd had as a firm at WisdomTree with HEDJ, that was really the first leg, in the sense that you saw last year it really took off, taking in about 15 billion as Mario Draghi turned on the QE spigot. And looking forward, what HEDJ was it was not as sensitive to the local economy because all the companies in there were exporters. So ultimately, if the policy is to work and Europe itself is to recover, which is the goal stated by the policy intentions, what you want is a greater sensitivity at times to what's going on inside Europe. Every constituent, at least 50% of revenue from inside Europe. So in a lot of ways, it's the opposite to HEDJ, focusing on domestically what's going on within Europe.
And the other thing we've seen since the Paris attacks is that the dollar has gotten stronger. I think it's now $1.06 per euro. You have another ETF called the Strong Dollar US Equity ETF. The ticker is USSD. So what are your expectations for this one?
So when we launched that during the summer, what we were thinking is it's a natural extension of the smart beta discussion. We saw how currency movements can impact equities in Japan. We saw how it can impact equities in Europe with ultimately DXJ in Japan, HEDJ in Europe. And what we thought is the biggest piece of the investment pie for many US investors is US equities. And yet every day you see on the S&P 500, the earnings reports come out. Stronger dollar hurts the companies that export. So what we do with the USSD ETF is we track an index where at least 80% of the revenue of every constituent comes from inside the US. It's a US domestic play, and you're really playing into the strength of the US consumer, which is ultimately helped as the dollar goes up.
And you also have the USWD, which is a weak dollar equity ETF. So when should investors look to use this one?
So it's a great point, and it's definitely the opposite take from USSD, the strong dollar option. In reality, what we see currently for the next 3 to 5 years is a general trend of a stronger US dollar, especially against the euro and the yen, as those central banks are printing money. However, what we know to be the case is the US dollar is not going to strengthen forever. No currency ever moves in one direction forever and ever and ever. These things are moving cycles, and there's going to come a time where it's going to be interesting again to think about those US exporters and to focus on companies that could do better as the dollar weakens at some point in the future.
You can't have one without the other, right?
You cannot.
All right. Thanks a lot, Chris.
Pleasure.
And thank you for watching The Street.